Yeah, so today we're going to go through really a very quick hour, 50 minutes really, because CPE rules. So we're going to go through the statutory accounting revisions that are applicable here at year ends, affecting your statutory accounting, your annual statement reporting. And then likewise, that's going to be about 25 minutes. And then I'll stop there and hand it over to Matt, and he will go through the one big beautiful bill, especially the components that affect your insurance companies, and likewise talk about R&D credits quite a bit as well. So, all right, so I'm going to go ahead and start off here. Let's go to the next slide, Kayla. Yeah, so as Kayla just mentioned, this presentation, I believe I heard she's going to send it out to everybody as of the end of the week at the latest. And these, when you do get it, these are live links. So meaning you can click on these links and literally for the accounting portion of this presentation, all the SSAP revisions and so forth, literally this is where it all came from. So these two links, it goes right to the NAIC sites. It's really very easy to use. One thing I always like to point out, when you go to the NAIC site, and you're looking at any of the blanks working group examples, always take a look at, there's a main summary table that tells you when it's effective and what industry, life, health, et cetera, PNC, because all those edits don't apply to the PNC industry, which I think most of the attendees here today are all PNC. All right, Kayla, I want to go to the next one. All right, so go to the next slide. We're just going to go into the statutory revisions now. And like I said, I keep saying the term revisions. That's because there are no new SSAPs in 25. There's no new accounting principles. These are just revisions to existing accounting principles. And likewise, when we get to the blank section, it's some amendments to existing disclosures that are already there as well. One item I do want to point out, though, because this gets a little confusing, even when I go to research this every year, too, is you'll see several references when you click on those live links for statutory accounting revisions. References is, 2024 dash a number. Many times those are just addressing GAAP, because SSAPs, the NAIC has to address every GAAP paper that comes out. So they're addressed, and many times they're rejected. So just because there's a reference and relating to GAAP, it doesn't mean it's actually being adopted. I'd say 9 out of 10 times it's being rejected. So you'll see several references I'll mention today, and that's the scenario. All right, as we go into 2024-01, you'll see a lot. This one's relating to clarifying guidance out there on the bond project and the principal-based bond definition. You'll see a handful of revisions related to that too, since the bond project has become effective. Next slide, Kayla. Okay, we got going down the line here. We got 2019-21. Again, this is more Q&A. This reference relates to Q&A related to specific questions related to the implementation of the bond project. So that's a good one to go to if you're having questions about that with the revised definitions and so forth. 2411, this one really, this is one of those ones I was just talking about. It's in essence rejecting the GAAP ASU 2023-09 revisions that basically would have expanded disclosures. That's going to be the case for GAAP, expanding disclosures for various jurisdictions, and even foreign taxes are to be disclosed now as well. That was rejected by statutory. The only item that was adopted, though, there was a minor deletion to the existing disclosure of cumulative deferred tax liabilities. So that no longer has to be disclosed. And we go down to 2417. If you're involved with, if your company has a hedging strategy, there's a new updated definition to clearly define the hedging strategy. That's at 2417. Okay, it's next page, Kayla. Okay, 2418. This one's getting involved with, there was clarification of accounting guidance related to tax credits what the language was saying in the journal entry examples they gave didn't match up. So so basically, at the end of the day, the guidance and the language used in the guidance was edited, and then to conform with the journal entries in the illustration were correct. So if you have, again, tax credits, recognition of tax credits, you want to take a look at 2418, and there's lots of good guidance there, and that's what this this reference is relating to, these revisions related to that. Okay, next item, Kayla. 2419. This one this is another example of rejected GAAP codification. Obviously, GAAP codification doesn't apply to stats, so that was rejected. That's an easy one. Next slide. So 2420. This one is getting into the restricted assets. So I'm going to touch on this topic, a couple different references, even some blanks working group. Just to start off, this is probably the biggest item for those working on annual statements here this season, this year in. There's more disclosure, expanded disclosure about restricted assets. This is by far the biggest item in the accounting portion of this presentation. And so now, in regards to 2420, there's additional disclosure required for restricted asset disclosure for modified coinsurance and funds withheld reported within a seeding company's financial statements. And this is all going to go as part of its note 5L. That's the note. And just some additional language related. These revisions illustrate how modified or modco and funds withheld shall be captured, as well as include a number of revisions, including aggregating all the restricted assets into a single table, identifying differences from items reported as restricted between 5L and the general interrogatories as well. And if you're the modified coinsurance, you know, if you're hearing that for the first time, it's a type of reinsurance where the ceding insurance company retains the assets and liabilities for a block of policies, but transfer the risk to a reinsurer. Thus, the assets are considered restricted. All right, let's go to the next slide, Kayla. And I did pass over the second item on that last slide. It relates to Medicare. There's a handful of references related to health insurance and Medicare. I'm just going to pass on discussing those. 2328. This is getting into adoption. See, there's more reporting lines, granular reporting lines on Schedule BA, and this relates to collateral loans. Next slide, Kayla. There we go. All right, 2324. This is referencing CECL. CECL was not adopted for stats, but for whatever reason, they felt the need to still include clarifying issue papers and things like that about it. So that's what 2324 is referencing. 2504, capital structure code. This item deletes the capital structure code reporting columns in various Schedule D schedules. Next slide, Kayla. 2505. Okay, this one is getting to expand. This is more into the restricted assets. This paper is actually, it's emphasizing this will be something to be disclosed in the annual statements and the quarterly statements in 2026 as well. 2508, again, another Medicare item. Just passing on that. Next slide, Kayla. So we got 2025-17 EP. This is just various editorial revisions to disclosures relating to the remaining credit rating provider designation for these bonds, and within the Freddie Mac when issued with a K deal. Very unique items. 2502. This one gets into, this relates to convertible debt instruments. So if you do hold convertible debt instruments, specifically the ASU clarifies how to the ASU from GAAP clarifies how to determine whether a settlement of convertible debt, particularly cash convertible instruments, at terms that are different from the original conversion terms should be accounted for under the induced conversion or extinguishment guidance. So again, if you have convertible instruments, debt instruments, you might want to take a look at 2502. Next slide. All right, this one primarily just relates to several GAAP items that were considered and then rejected. That's really the focus of all these various references at the bottom. Let's go into the next. So that sort of covers the main revisions. Kayla, let's go into the next section. Okay, the blanks working group. Okay. All right, so going down, now a lot of these will tie to the revisions we just discussed. But again, going back to those links, you can go to the live links and it will take you right to the detail if any of these are you think could affect your company or impact your accounting for your company. So starting at the top, 2419 is more edits related to the bond project and updating the line categories on Schedule BA. 2416 is making some modifications to the investment interrogatory since mortgages and real estate are not considered short-term. That's what the revision's related to. 2501 is dealing with derivatives, an update to note 11. 2502, income taxes. That simply just relates to the elimination of the cumulative amount of each type of temporary difference for deferred tax liabilities. I mentioned that before. 2504 is a healthcare item. 2506, this is again back to the restricted assets, the note 5L. This item, instructions and illustrations relating to the revisions of the note to include collateral assets received on the balance sheet, and then assets under ModCo reinsurance agreements. Assets held under funds withheld reinsurance agreements as well. So 2506 is a good one to look at, and then on the next slide, I'll cover another one that relates to the restricted assets as well. Last item on the page, 2507, that relates to some minor revisions to the Schedule P instructions. All right, Kayla, next page, there we go. All right, so 2510, this is probably, when I was researching, this is probably the best one to go to, I think, if you really want to find what you need to be disclosed in the restricted asset 5L. It gives really good illustrations and some additional definitions of the type of restricted assets to include. So this would be like your go-to link, I think, 2025-10. That's probably the best item to go to click to understand further about the disclosure. Let's see, 2511, again, removing the capital structure code. 25-13, some additional updates related to financial disclosure note 13K related to surplus notes. And actually let's see, purpose is to clarify the guidance for reporting certain debt securities as capital notes. That's what that modification is addressing. 2514 is Medicare. 2515 is getting into minor edits to wording used for derivative financing premium in the annual and the quarterly statements. All right, and then the last one, 2413, is the update annual statements, investment schedules for editorial items for the bond project. All right, going at the top there, 2414, really just one wording change that's applied to most Schedule D parts, simply rewording the issuer credit obligation line category to be called the bond issued by funds representing operating entities. So don't shoot the messenger, I'm just presenting some of these. So that is the modification with 2414. And then the ones in the middle here, we got 2415, that's removing ACA disclosures. 2417, that's pet insurance. So this one's I always think's interesting. So those of you, I'm not aware of any of my clients selling pet insurance, but there's definitely companies out there that are. So that's what 2417 relates to. 2418 is healthcare exhibit. 2420, I think it is interesting. This one, it's for electronic only contact information. So the purpose is to add assessment contact, so guarantee assessments. So assessment contact to the jurat page so members can contact insurers about guarantee association operations. And this adds the name, you want to add the name of the person responsible at the company for managing and paying state guarantee association assessments. So that's an interesting one, I think, combined with all these other edits. 2420 is clarifying instructions at the sale of a, it's talking about the sale and purchase of a security. So they've added clarifying instructions. The sale of a security that is reacquired with different terms shall be reported as a sale on part 4 and a new acquisition on part 3. Again, the key is they have different terms. Let's see, 2422. Again, this is another item updating BA, other investments for capital notes and surplus notes. Next page, Kayla. Here we go. Okay, this one, 2411 at the top is discussing SSAP 93, low-income housing tax credit property investments, and SSAP 94, transferable and non-transferable state tax credits resulting from the new market tax credit project. So there's been modifications to the instructions how to report these items. 2412, basically consolidating all the quarterly edits for the bond project all into one proposal. And so that's what sort of like a landing spot for all those edits. 2312 is updates to Schedule BA categories for items that do not qualify, no longer qualify as bonds. 2402 is to remove categories from Schedule DA and E that should be reported now on Schedule BA. All right, the last slide. This one I think is sort of interesting. You look at it quick, you're like, oh, this dates back to 2023, the very first one, 2306. This one's the biggie. This one is the one that splits Schedule D Part 1 into 2 parts. So we've talked about it in past years, but actually it's now become effective here as of year end with the annual statement. So your Schedule D will be in part 1 will be in 2 parts this year for the first time on the annual statements. You will have one for credit obligations and the other for asset-backed securities. So that's a big item there. And then 2307, simply just deleting legal entity identifier column. Okay, let's go. We can, with Kayla, we'll probably I'll go through these pretty quickly. This is just sort of emphasizing some of the ones we just discussed. So again, we have the, this one, it's again, just highlighting this note 5K, goes back to reference 2411 and updating these instructions related to the low income housing credits and the SSAP 24 transferable, non-transferable state tax credits resulting from new market tax credit projects. So that's the one I just touched on. Next slide is restricted assets. So we talked about that a bunch. 25-10 is the key paper to look at in the blanks to understand the additional disclosure as good illustrations and so forth. Okay, so let's go with, now, note 9, income tax. Again, really minor item, just simply deleting that cumulative temporary difference disclosure item. Note 11, this is interesting because I think a lot of companies have lines of credit. I mean, almost all my clients have a line of credit, and usually they're unused. So again, note 11 is providing information for unused commitments and lines of credit. So that's to be disclosed. Go to the next slide. Okay, 13K surplus notes. This one's really just getting it, and this is, I've touched on this a little bit during the presentation, but there's some minor clarification of definitions of what's, so the definition between surplus notes and capital notes. So that's what this one's about. Again, if you have either of these, take a look at it. The key item is that last bullet there, the capital notes held, debt securities that do not qualify as issued surplus notes pursuant to 21 that are treated as regulatory capital by the insurer's primary regulatory authority do not qualify in the principal-based bond project. Okay. All right. Let's go to the next slide. Contingent commissions. There we go. Yeah, just so again, if there's any commitments to purchase tax credits, those are to be disclosed. Again, it's the commitment, even if you haven't purchased them yet. And then likewise, in regards to any unused tax credits, disclosure and commitment of contingent commitment to purchase tax credits. So a lot of focus on tax credits. And if you're buying them, haven't bought them, committing to buying them, et cetera. So if you have any scenario like that, more than likely there's some disclosure that would apply. Now let's go into the exposed. Yeah, so these, I'm just going to take about another minute or two to go through these. These are all exposed. And to point out too, there's been, I put this presentation initially as of August. There's been a couple meetings since then. Nothing really major has come out since then. It's just, and a lot of the items that were exposed are still exposed. And so anyway, so as we go through, this is an item, leases here, 22. So again, these are exposed items here. This agenda item intends to provide guidance that sale leaseback accounting would not be applicable in situations in which the seller insurer is restricted from readily accessing the sale proceeds. In such instances, the financing method would be required. Okay. So again, if you have any sale leaseback type items you're either in or thinking about, maybe take a look at being on top of that exposure. 2520 proposes consistent disclosure for certain reporting elements between SSAP 26, 43, and 21. Next slide there, Kayla. All right, let's see, 2513 is relating to mortgage loans. Exposed revisions to the draft guidance allowing residual mortgage loans and trusts to reflect several recommended changes discussed by the industry. 92, so post-retirement other than pensions and also 102 pensions. Exposed revisions to clarify that retirement plan assets can be held at NAV or net asset value and shall be included in the required fair value disclosure. And then 101, exposed revisions to adopt with modifications certain revisions from ASU, so GAAP, ASU 2019-12, which would be simplifying the accounting for income taxes. So again, that's exposed right now. All right, and last slide for me is with 2519, exposed revisions to incorporate a new disclosure to identify private placement securities in the investment schedule. And then 2421 exposes revisions to eliminate investment subsidiary concept from the instructions. And that's sort of confusing. That's when you first read it, you're thinking, well, subsidiary is investment, but it's talking about subsidiaries that the sole purpose of them is investments. So it's a little unique. It's not a subsidiary that has separate operations, things like that. So again, if you want to learn more about that, that's 2024-21. And again, it's eliminating the investment subsidiary concept from the instructions. All right, well, that's all I have. And I guess, Kayla, were there any questions?
I am not seeing any questions at this time, Scott.
Okay, all right, great. Okay, well then I'm going to hand it over to Matt to lead the second half.
Thanks, Scott. So the second half of today, we would like to walk you through some of the key tax provisions, including the recently passed One Big Beautiful Bill Act, or OBA. That bill was enacted on July 4th, which introduced several significant changes that will directly impact businesses, especially those of us in the financial services and insurance space. As far as objectives, those are pretty straightforward. First, just to help you understand what OBA's business-related tax changes are and what they mean in practice. The second point is just to compare these new provisions with the rules we've been living under since the Tax Cuts and Jobs Act, so you can not only see what's changed, but also why that matters. And then third is just to identify potential planning opportunities that might help optimize tax outcomes under the new law. So if we go to the next slide, one of the major changes was bonus depreciation. Under the old law from the Tax Cuts and Jobs Act, businesses were able to take 100% bonus depreciation on qualified property, but that only lasted through 2022. After that, it began phasing down 80 and 20% increments. So in 2025, that was going to be down to 40%. And then by 2027, it would be completely phased out. Again, this applied mainly to tangible personal property with a recovery period of 20 years or less, along with certain real estate improvements. The new bill makes a major change here. It permanently restores 100% bonus depreciation for qualified property acquired and placed in service after January 19th of 2025. On top of that, it further expands the scope to include manufacturing buildings placed in service before January 1st of 2031. Obviously, that impact is pretty significant. By allowing full expensing up front, the new bill encourages businesses to make immediate capital improvements, since they can now deduct those costs in the year of purchase rather than spreading that over time. If you go to the next slide. So this slide relates to Section 179 expensing. Under the Tax Cuts and Jobs Act, the maximum amount a taxpayer could expense under 179 was set at $1 million, but there was also a phase out. So once the total cost of qualifying property exceeded $2.5 million, that $1 million deduction began to shrink. The new bill makes the provision more, well, I'll say generous, starting with property placed in service in taxable years beginning after December 31st, 2024 or 2025. The maximum deduction jumps to $2.5 million, and then the phase out doesn't kick in until the cost of the qualifying property exceeds $4 million. The impact here is similar to bonus depreciation. Again, it encourages immediate capital investment by allowing businesses to fully expense those purchases up front, obviously directly reducing taxable income in the year of acquisition. 179, I would say, is more, or particularly more helpful for mid-sized companies that previously bumped up against the phase-out threshold. We can go to the next slide. Now that we have covered kind of the mechanics of Section 179 and bonus depreciation, I wanted to talk about some important considerations when deciding how to apply these provisions, or which provision would be more applicable or could be better off for you. So first, Section 179 expenses cannot create a business loss. So that means that you can only deduct Section 179 up to the amount of taxable income generated by the business. Bonus depreciation, on the other hand, can create a net operating loss or a loss, allowing businesses to carry those losses forward to offset future taxable income. For our insurance companies, that would be a 20-year carry forward. If you have some non-insurance operations like an agency, then you'd have an indefinite carry forward period. Second, I think it's also critical to understand kind of the state treatment. Many states, and for instance, Pennsylvania, do not conform to federal bonus depreciation rules, whereas Section 179 is generally recognized at the state level, though those limits are often at a lower level. That can affect the timing and the amount of deductions for state tax purposes. Our third point is just considering how the assets are financed. Using debt to acquire depreciable property can have implications for both federal and state taxable income, particularly when deciding between Section 179 and bonus depreciation. I would say if you need to make capital investments and you're going to use some debt financing with some of the new rules for 163J, which we'll get into a little bit later, and then obviously now with 179 and bonus being more generous deductions, it's probably more lucrative to use debt financing again to make some of these capital investments if you were thinking about pursuing that. And then finally, think about future taxable income. Since Section 179 is limited to current year income again, and bonus depreciation can create or expand a loss, your choice may depend on whether you expect higher or lower taxable income in future years. Obviously, proper planning can help optimize both your federal and state tax outcomes. We can go to the next slide. So next, let's talk about business interest deductions. Under the old law from the Tax Cuts and Jobs Act, business interest deductions were limited to 30% of adjusted taxable income, or ATI. Originally, ATI was calculated using EBITDA through 2021, but then starting in 2022, it switched to an EBIT-based limitation. Obviously, that made the limitation more restrictive and less generous for many businesses. The new bill makes a significant change here. Again, for tax years beginning after December 31st, 2024 or 2025, it permanently reinstates the EBITDA base calculation for ATI, again, making the interest deduction more generous again. I'll say that generally this doesn't normally apply to insurance companies because the limitation only kicks in if interest expense is greater than interest income. Because of the interest income generated from the bond portfolio, this generally excludes insurance companies from the limitation. However, I have seen this apply to a few insurance clients. Normally, again, this would be within a consolidated group where the parent or some sort of holding company takes on a large amount of debt. So that's kind of the one scenario I've seen it, but generally the 163J rules will not apply to the insurance industry. We can go to the next slide. This slide, it just shows up the phase out of the clean energy incentive and credits. I didn't want to spend too much time on this slide, but just to note, many of the federal clean energy credits are going away under the new bill. So if your company has investments in renewable energy projects or was maybe planning on taking advantage of these credits, I would say it's important to review and reassess those positions just because the tax benefits you may have counted on are no longer going to be available. As you can see from the slide, most are going away by the end of 2025. So that's just something to consider. We can go to the next slide. The employer-provided child care credit. Under the old law, the Tax Cuts and Jobs Act allowed employers to claim a 25% qualified child care facility cost credit with a maximum annual credit of $150,000. The new bill, I would say, makes the credit significantly more generous again, and increases the credit to 40% with a maximum annual credit of $500,000. And then for eligible small businesses, the rate rises to 50% with a maximum of $600,000. Obviously, the impact's pretty straightforward. Employers who provide childcare support can now claim a larger credit, obviously creating a more meaningful incentive to invest in childcare benefits for employees. We can go to the next one. This slide deals with the paid family and medical leave credit. Similar to the employer provided child care credit, were also some changes to the paid family and medical leave credit. Again, under the old law, the credit allowed employers to claim between a 12.5% and 25% of wages paid to employees on FML. and that was set to expire after 2025. The new bill makes the credit permanent, adds a new option, and that option's employers can now calculate the credit based on a percentage of premiums paid for FML insurance instead of wages. This change provides more flexibility and a long-term incentive for employers to support employees taking family and medical leave, while potentially increasing the amount of credit for those who purchase FML insurance. So something else to take advantage of. And then the next slide basically just kind of goes in through a couple other provisions, just kind of worth noting. First, for C corporation, there's a change to the charitable contribution limitation. This is probably a bigger one. This one will affect the amount of deduction or deductible contributions in a given year. Corporate charitable contributions will now be deductible only if they equal at least 1% of your taxable income. And then the total deduction remains capped at 10% of taxable income per year. So this takes effect for tax years beginning after December 31st, 2025 or 2026. That's a key note there, that it won't be impacted in 2025. It starts in 2026. I've seen some of my clients and their quarterly provisions trying to incorporate the new rule. You obviously won't have to do that until you start working through your Q1 2026 provision files. But the 10% cap has always been around. The 1% floor is new. From what I've read and seen, basically a study was done that a majority of corporate taxpayers on average spend about 0.7% of taxable income on charitable contributions. So this was in the bill to increase charitable spending, or with the hopes that it would increase charitable spending. And then also, because the bill was done through the budget reconciliation process, they needed a revenue raiser in the bill, because with budget reconciliation, you can't increase the debt over that 10-year window. So that's kind of why they've increased this one, but definitely something you want to be aware of, and things that we'll need to be do some planning on if you guys are or your insurance companies are making charitable contributions. The second kind of miscellaneous item I have is just some of the reporting thresholds for information returns. There's been some updates there. Form 1099K reverts back to the old threshold of $20,000 and 200 transactions. Your Form 1099 Miss and 1099 NEC, those thresholds increase from $600 to $2,000 for payments made after December 31st, 2025. And then that will also be adjusted for annual inflation adjustments beginning in 2027. And then finally, the OBA retroactively impacts the employee retention credit, invalidating claims filed after January 31st, 2024 for that third and fourth quarter of 2021. There were some other items with the employee retention credit to be aware of. Hopefully no one here made any fraudulent employee retention credit claim, but there were some additional measures in that bill too to kind of combat some of the fraud that they saw with the employee retention credit. So taken together, these provisions affect reporting compliance and planning for businesses. So it's important to review your internal process and prior filings to ensure, obviously, alignment with the new rules. We can go to the next slide. Outside of bonus depreciation, the main change that will impact the insurance industry relates to the deduction for research and experimental costs under Internal Revenue Code Section 174. I know we've worked a lot with our clients over the past couple of years on this. This is especially applicable if you have some sort of software upgrade where you're doing customization, but not necessarily just configuration. Under the previous tax rules, costs paid or incurred for R&E in tax years after December 31st, 2021, or tax years 2022 are required to be capitalized and amortized. The amortization of U.S. costs is over 5 years and then 15 years for foreign costs. Starting January 1st, 2025, businesses can fully deduct the domestic R&D expenses rather than requiring to capitalize and amortize them over multiple years. I'll say this is a significant change that can improve cash flow and reduce taxable income in the year these expenses are incurred. It's important to note that this only applies to domestic expenditures. Any of the foreign research and experimentation costs remain subject to that 15-year amortization rule. And then the legislation also provides some flexibility. Businesses can elect a 60-month or 5-year amortization, or they can deduct any unamortized Section 174 costs either in full in 2025 or spread over 2025 and 2026. And then finally, the new bill retroactively provides relief for small businesses, allowing them to benefit from these provisions, even if they incur R&D expenses prior to 2025. And I will say they did come out with a revenue procedure. I believe it was 2025-28 in late August, early September, which provides some guidance for the recovery of the previously capitalized R&D. If we could go to the next slide. Recovery of previously capitalized R&D. OBA also provides retroactive relief for small businesses with average gross receipts of 31 million or less. Those businesses can amend returns for 2022 through 2024 to claim full immediate deductions for domestic R&D, potentially recovering previously deferred expenses. Any remaining unamortized domestic R&D can be deducted in 2025 or spread over 2 years, providing additional flexibility in tax planning. I would assume most people would be that are not small businesses would probably be taking the deduction in 2025. But if you find yourself in an NOL position or you have some tax attributes, maybe expiring in 2025 and you don't want to take that full expense to give yourself some taxable income, that might be a scenario where you would want to choose to spread it over the 2-year window. Again, the legislation also allows small businesses to adjust the treatment of the R&D credits and estimated payments, giving them some more control on how the incentives are applied. We can go to the next slide. My next couple slides are basically talking about 174 versus the R&D credit. I'll go over these fairly quickly. I know we've got about 10 minutes left until our hour expires, and at this point we have hit our full 50-minute window. But I'll probably cover these in about five-ish minutes, and then we'll leave some time for any questions. So this slide is just basically clarifying the relationship between IRC Section 174, which is the R&D expenses, and IRC Section 41, which pertains to the R&D credit. A key point to remember is that all Section 41 R&D credit expenses must qualify as Section 174 expenses, but not all Section 174 expenses qualify for the Section 41 credit. And so the reason for this is Section 174 has a broader definition covering a wider range of costs. And so we list some examples. There's office and overhead costs, employee payroll taxes, benefits and insurance, patent and patent pursuit costs, utilities, and then contractor research, again, which is fully deductible under 174, whereas only 65% is typically eligible for the 41 credit. Understanding those differences is critical for planning both deductions and credits effectively, so you maximize the tax benefit from your R&D activities. We can go to the next slide. I believe this is just another slide that goes into more granular detail what the costs are applicable for the R&D tax credit. So this is just another example of what cost would qualify for the credit. We can go to the next slide. Again, we've been getting a lot of questions related to the R&D tax credit over the past few years due to the change in the 174 capitalization and amortization. So if you have a software project where you think you might qualify for the R&D credit, here are just some of the rules. Again, to qualify for the R&D tax credit, a company's innovation doesn't need to be new to the world or even new to the industry. It just simply needs to be new to the business. In addition, the IRS requires that research activities meet a 4-part test. So the first one is permitted purpose. The research must create a new or improved product or process that enhances performance, function, reliability, or quality. It's got to be technical in nature. The activity must rely on one or more hard science, such as engineering, physics, chemistry, biology, or computer science. It also must eliminate uncertainty. So the research must attempt to eliminate uncertainty regarding the development or improvement of a product or process. And then the last one, process of experimentation. The company must evaluate alternatives to achieve the desired result. That can be demonstrated through modeling, simulation, trial and error, or any other type of experimental method. Meeting those 4-part tests or that criteria ensures that a company does have innovation activities and they're then eligible for the credit, which again can provide a significant tax incentive for your investment in your research and development. We can go to the next slide. Again, this is a nice visual aid that just kind of adds on to the 4-part test that we discussed before. We can go to the next slide. This is just talking about the conforming changes to Section 41 and then 280C. Again, OBA modified several key provisions related to Section 41 and 280C, which those code sections govern the research credit. Taxpayers claiming the gross research credit must now reduce their domestic R&D expenditures by the amount of the gross credit. Alternatively, taxpayers can elect to claim the reduced research credit on a timely filed return, including extension. That approach aligns with the pre-TCJA rules under Section 280C, maintaining flexibility with how the credit is calculated. And then finally, Section 41D was amended to require that the expenditures must be treated as domestic R&D under Section 174 in order to qualify for the credit. That ensures that only eligible domestic research activities are counted towards the credit. Again, emphasizing what I'll say, the importance of proper classification under 174. If we could go to the next slide. Accounting method changes. Although, again, the new bill provides new rules for Section 174 and the R&D credit, IRS guidance is, I would say, was still needed on how taxpayers should make these elections in practice. Again, in late August, early September, they did come out with Revenue Procedure 2025-28. So we do have this guidance now on the accounting method change, and then with rules on how to treat those changes. If you could go to the next slide. Let's skip this one too, because again, a lot of this was what we were maybe expecting prior to that revenue procedure coming out, but now that we have it, you can reference that revenue procedure for the next steps to take under 174. Let's go actually to the second last slide, just with what time we have left remaining. Yeah, I think this one is probably a good one to kind of wrap up on. Again, this has been just a high level overview of business provisions of the new Big Beautiful Bill Act. Many of these changes are significant, but in the near term, we expect additional regulations and IRS guidance to be issued, which will provide more clarity on implementation and compliance. And then we have an example. So, in early August, the IRS announced that Forms W-2, 1099, 941, and other payroll return forms will remain unchanged for the 2025 year, and federal income tax withholding tables will not be updated to reflect the OBBA provisions. So that was the change we saw. Again, I mentioned Revenue Procedure 2025-28, which came out in late August or early September, which was the first comprehensive guidance on the new rules for domestic research and experimental costs. The revenue procedure basically tells companies how they can elect to immediately deduct or amortize the domestic R&D expenditures, including software development costs paid or incurred in tax years beginning after December 31st, 2024. And then also it gives some options for recovering previously capitalized R&D expenditures before that date under the Tax Cuts and Jobs Act. And then I guess finally, my key question at this point is now that we do have some guidance on some of these rule changes, but how will the states respond? Some may adopt the new federal rules while others may decouple. So businesses definitely, we need to monitor the state level guidance closely to ensure compliance across all the different jurisdictions. But I would expect a lot of that stuff to come out on the next couple months here. Hopefully, obviously, we have more guidance, at least from the states, by April of next year. The filing deadline, or at least the extension deadline. So,
well, great. Well, thank you to everyone that joined us today. Really appreciate it. And from our perspective, Matt, I think hope everybody has a happy holiday season.